Hi, everybody. My name is Bronson Hill, and I'm here with the Michael Blanc. Welcome, Michael.
Thank you, Bronson. Great to be here.
And I work with Nighthawk Equity. I'm the Director of Investor Relations, so I have calls with investors, and we got a lot of questions that come up. So one of these questions that come up is about tax benefits and understanding cost segregation and bonus depreciation. So, Michael, can you answer for our investors, just give us an overview of cost segregation and how it affects passive investors, particularly in a multifamily syndication?
Yeah, so cost segregation is one of those, I wouldn't say legal tax loopholes. It's been an advantage of real estate for decades. And really the way it works is the IRS allows you to essentially write off a paper loss from your taxable income. So typically if you have a house or a townhouse or rental property, you can write off the entire value of that over the course of 27 and a half years, which is great, right? So you have a certain amount of income and you have your expenses, you have your mortgage, you have your expenses, you got to replace a boiler, and you deduct all that from your income, and left is this taxable income. But you're not done yet. You have the depreciation of that, which you can count as a loss on your tax return, and that shrinks your taxable income. It's one of the best tax advantages. And cost segregation, what that's doing is it allows you to what's called accelerate that depreciation. So typically, without a cost segregation, you can depreciate the value of the apartment building over 27 and a half years, what we talked about. Cost segregation accelerates it. Here's how it works. You send out some kind of engineer. The engineer's got this giant spreadsheet, and he breaks the entire building into its constituent parts, roof, electrical wiring, carpet, appliances, furniture, brick walls, driveways. And the IRS allows you to depreciate these different things in different time schedules, right? For example, a carpet, they might depreciate over 5 years, or roof maybe 15 years, electrical wiring, 15 years, whatever the case may be. So they take all this thing and then they apply the tax code to all these elements. And the upshot of all this stuff is that about 90% of the value of the building is depreciated in the first 7 or so years. Now that's very powerful, right? That's very powerful. Now it goes a step further. When Trump was elected office, because he's a real estate investor, he passed a slight tweak to the law, which now is called bonus depreciation. And it basically allows you to deduct 100% of the value of the building in the first year. And it's typically it used to be able to apply it only to new equipment. So new things like new equipment, a tractor or something like that. And then he tweaked it to go to used equipment, which then translated into real estate as well. So this is amazing, right? This is really the amazing part of it is now I can deduct almost the entire cost of the property building, not 100%, it's like 90%, but in that first year, so you have this giant taxable loss. And that's why for all of our properties that we do with Nighthawk Equity, we always do a cost segregation analysis and pass that bonus depreciation on to our investors.
So if I'm an investor in a syndication deal, like what does that look like in practical terms as far as what I can write off?
Yeah, so perfect example. Let's say you invest $100,000 in one of our multifamily syndications. And let's say we distribute $8,000 return on that money. It's an 8% cash on cash return. You're putting that money in your bank account. You're going on vacation with it. You're spending it, doing whatever you want to do with it. And then come tax time, you get your what's called a K-1, which is your tax statement. That K-1 is what you give to your CPA to do your taxes. Well, on that K-1, it has the fact that it has $8,000 was distributed, but magically your taxable loss was like $40,000 or some giant number. You're like, your CPA is going to look at this and going, what the heck happened? You lost money on this? This is a really bad deal. And he goes, no, don't you worry. I actually made money, but it's a taxable loss. And this is why, for example, when people are attacking Trump and they're like, oh my gosh, you've lost money over the last decades in your business. You must be a bad investor. It's because of this. So he has a taxable loss on his real estate. Meanwhile, he's putting millions of dollars in his pocket. That's what the normal person does not understand. So the multifamily investor gets to put money in their pocket and not pay taxes on it, or at least defer the taxes of it. And that's really the beauty of this bonus depreciation, that you have this taxable loss and you can use it to offset other passive income. Let's say you're investing in other passive things or businesses or oil. You can use it to offset the other passive income. And if you don't use it, you can roll it forward to the next year. And so if you have an income the next year, another $8,000, you can then offset that gain with any kind of passive losses you haven't used yet. Brilliant.
I think it's amazing, the idea that you can, whatever you don't use, you can roll on to the next year, and you basically have these passive losses and these paper losses. A lot of people that I know that are, full-time investors, they basically pay little or no taxes, which is kind of amazing when you think about, how much money they make, whatever, and paying little or no taxes. The government has actually really set this up to be an advantageous thing for real estate to incentivize it. So approximately what percentage, or how does the breakdown of what's deferred and what's avoided as far as taxes in a multifamily syndication?
So that's a very complicated question that only your CPA professional can answer. But I'll wave my hands a little bit. But so there's this idea of tax deferment and tax avoidance. So depreciation in one sense avoids taxes in one sense. And I'll talk about why it's deferring taxes. It avoids taxes because the IRS considers it as an expense and therefore reduces your taxable income right now. So in that sense, you're literally avoiding taxes. Now, when you sell, you may have to pay taxes on the gain. And this is kind of where you can argue that depreciation could be a deferred tax. So for example, when you pay taxes, you have paid taxes on the gain. You buy it, let's say $1 million, you sell it for $2 million. There's a $1 million gain, right, that you pay taxes on. But because of the depreciation, it lowers your basis. So in other words, when the IRS calculates your gain, it's not on the $1 million purchase price. It's $1 million minus whatever you depreciated. So let's say I depreciate $800,000 from bonus depreciation. My actual basis, my starting point, is $200,000. So as far as the IRS is concerned, they're going to tax you on a gain from, say, $200,000 to $2 million. So it's a $1.8 million gain. And now you're taxed on that. And that is called depreciation recapture. So you're getting the benefit of the depreciation now, but you may have to pay for it later. Now, there are mechanisms to defer that tax as well. And for example, something called a 1031 exchange, Bronson, right? So 1031 exchange essentially allows you to take the money, the gains you've made, and roll it into an equal or greater piece of real estate. So let's say you're in the Bay Area and you own a house and you have like $500,000 of equity in that house because you held it for 10 years and you don't want to pay the gain on that. You can do a 1031 exchange and take that $500,000 equity and profit and roll it into, say, a small apartment building without paying taxes on that. And there's a process for that. There's a procedure for that. We can do a video on that some other time. But the point is you then defer those taxes further on. So the way the real estate is constructed, if you play your cards right, if you know the system and you're working with a good strategy, good tax advisor, you're going to pay very little, if any, taxes at all. And I got to tell you, I've been working with Tom Wheelwright's group. His company is called Wealthability. And I've been looking for a tax strategist for a while to help me with some of these things. And they're amazing because normally a CPA just prepares your taxes. That's kind of what they do, but they don't help you in the planning of these things. So they'll actually sit down and look at what you've done, your entities, your activity previous and also future, and they will advise you on what to do. For example, they even look at operating agreements, how the depreciation is structured. Could it be structured differently going backwards? How should you structure that moving forward? So these are some things where you really want to work with someone who is an expert in real estate investments because the tax benefits are enormous. Now, I love Tom Wheelwright's philosophy is not that he's going to save you money. His only question in his mind is how are we going to do it?
Yeah. Well, I know, Michael, taxes can get a little complex. So I appreciate you kind of breaking some of this down for our audience. So just wanted to, again, for all of you listening and watching today, just wanted to say thanks for taking the time to educate yourself. A couple things, maybe you're interested in investing in apartments, it's kind of new to you. You're not quite sure what the next step is. Well, there's this great report that Michael put together comparing the stock market and real estate. If you go to themichaelblanc.com/report, you can go check that out there. It's very compelling, makes a really great case about why everyone should be interested in passive income through apartment investing. And then the second thing, if you're already there, you're like, hey, I'm ready to be involved. I want to hear about deals. Join the Nighthawk Equity Deal Club. We have deals regularly. If you go to nighthawkequity.com, click the join button, you'll set up a call with us and we'll get to know you and develop a relationship. But again, thanks so much for taking the time and we'll see you on the next video.
Hey, don't go without grabbing that free report. That's right here. And subscribe to our YouTube channel because we put out videos like this every week. You don't want to miss it. And check out this other passive investing video.